please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
On the show, a very, very special panel of guests. The former Economic Affairs Secretary, Shakti Kanta Das, a man who understands the budget and, more importantly, understands the budget fine print. Mr. Das, appreciate you joining us here on the show. Also with us, joining us, Ratin Roy, member of the Prime Minister's Economic Advisory Council, Neelkant Mishra of Credit Suisse, who's been with us through the day on our budget programming. We also have with us, lining up from rating agencies, William Foster of Moody's Investor Services, Ravi Bhatia of S&P to give us their sense of what they make of the budget. And of course, from the financial sector, the two veterans I have with me, Deepak Parekh of HDFC and of course Chanda Kochhar of ICICI Bank. Appreciate you joining us here on the program. Mr. Parekh, straight to you now, sir. You know, there was a lot of focus on whether the government would stick to the path of fiscal consolidation. What we have seen is now that versus 3.2, which was the expectation for FY18, they've done 3.5, versus 3%, which was the expectation for FY19, they say they will do 3.3%. What do you make of the fiscal consolidation roadmap? The numbers, are they credible?
See, my personal view on the fiscal deficit is that we've had an exceptional year. Last year was not an ordinary year. The transformational reforms started by the government have had an impact on the fiscal deficit. We've never had demonetization. GST took years, 10 years it was in the making. To convince all the state governments and to start a new tax regime is not easy in a large country like India. Look at the disruptions that have happened during the year. So obviously there have been months where there was no income, there was no revenue during the December month last year. So maintaining it at 3.5% as the previous year, I think is an achievement. And being practical, 3.3% next year is also being more realistic because we do need to spend a lot of funds for infrastructure, for roads, for railways and health and education. You have to be practical. We are a poor country in India. We need to bring the people up from their poverty line, and I would say this has been an Aam Aadmi budget.
Okay, so you're saying that you don't mind the fact that there has been a fiscal slippage and you believe that the number they've delivered on is a credible one. Let me take that point to you then, Chanda Kochhar. Do you believe that investors will be a little forgiving given the fact that the government has decided to accept the recommendations of the NK Singh committee, which means they tie themselves down to a fiscal deficit target of 3% by 2021 and also a tax to a debt to GDP ratio of about 40%. So that is a commitment now that they've accepted the recommendations of the FRBM committee headed by NK Singh. Will investors be more forgiving?
Well, I think it's a very, very responsible approach to fiscal prudence and fiscal deficit because, you know, on the one hand, he's balanced all the investment and spending requirements of the Indian economy, and on the other hand, shown the clear glide path for fiscal deficit from 3.5 to 3.3. And, you know, let's not just focus on that. I think the other important part is adopting the FRBM and saying that the central government debt would be restricted to 40% of GDP. I think that's also a very important statement on fiscal deficit. And the way I look at it is also innovative ways of raising funds for investment. I think that's also fiscal discipline in that sense, to say that, you know, I will take all the ready roads and against that raise funds, or airports and raise funds against that, use InvITs, use the land around railways and raise funds. So I think there is a whole lot in there which really focuses on how do you do responsible fiscal management.
Okay, so there's consensus there between Deepak Parekh and Chanda Kochhar on the fiscal roadmap. Let me bring in the two rating agency points of view now, Moody's and S&P. William Foster of Moody's, let me start by asking you, William, when we spoke last, you said that you had factored in 3.5% for FY18. That is the number that the government has delivered on, and they're talking about 3.3% for FY19. What's the Moody's view?
As you said, this is consistent with our expectations. So I'd say in general, the budget, at least the fiscal consolidation pass, is more or less what we had expected. The really important thing, I think, from a credit profile perspective is the medium-term commitment to continuing a consolidation path in the future that will bring down the debt-to-GDP ratio over time. Obviously, we've mentioned that the FRBM committee recommendations were referred to in the budget speech with the intent to bring down the central government debt-to-GDP ratio to 40%. We still don't have all the details around how that will happen, but I think what's important is that the government does seem to be committed to doing that over time. And obviously, the way that they do that will be important. I think another aspect of the budget that is particularly interesting moving forward is obviously GST was very disruptive this year to revenues, and that's part of the explanation for the slippage this year. But next year, it will be important to see GST start to stabilize as compliance starts to filter in through the economy and the formalization process starts to get entrenched. That will be an important determining factor whether the next year's target of 3.3% will indeed be hit.
Absolutely right. But William, outside of the fiscal consolidation roadmap, what did you like about the budget? And do you believe that this budget has what it takes to ensure that we look beyond the 7% growth target?
I think what's important when you look at both the economic survey and the budget, one of the most important things moving forward is the extent to which tax collection and the broadening of the tax base occurs, both following demonetization, but also through GST. We're starting to see inklings of reassurances on that front that this is indeed happening. So that will be important moving forward. To continue to be the case if India's tax revenue to GDP is going to go up, and how the ultimately revenue to GDP will provide the resources for spending in the future. On the spending front, continued commitment to focusing on capital expenditure and infrastructure spending. Obviously, there's a focus on rural roads and rail in this budget, just as there was in last. Those are very important to contribute to potential GDP growth moving forward. I think generally the assumptions around both expenditure and revenue seem to be achievable, but I think, as I mentioned before, the GST question is still, I think, the most important one moving forward. Will be important to hit that deficit.
Absolutely, but let me get Ravi Bhatia of S&P in on the conversation as well. Ravi, appreciate you joining us. Moody's there saying that the fiscal plan is along expected lines. They expected the slippage. What's your take on the fiscal slippage that we've seen that's been announced in the budget?
Yeah. I mean, there's definitely been some fiscal slippage. I guess we sort of knew that for financial year 17-18, but the news is on next year. I mean, to a certain extent, we know that this is a pre-election budget, so we sort of expected some fiscal slippage. So we've kind of factored that into our overall analysis on India, but it's still a concern that there was quite a significant fiscal slippage, and the question is also what this will indicate to the states, because we look at the fiscal deficit on a consolidated basis with the states as well. So going into in the year before the election. The combined deficit. So that was a bit of a concern.
Okay, so in that context then, Ravi, does this prompt you to at all look at a possible review at this point in time, or there's no case for that?
I mean, it depends how you look. Well, I mean, we're looking at the whole picture. As I said, we factored in a certain amount of pre-election or election-tied fiscal slippage, and we look at also at the overall debt numbers. So that's where we are right now.
Okay, let me get a former budget maker now, Shakti Kanta Das, the former Economic Affairs Secretary, here with us. So you understand the political compulsions and the pulls and pressures. In that context, do you believe that the budget has delivered on not just being able to stick to the broad fiscal consolidation target roadmap that the finance minister has committed himself to, but also to try and address some of the pain that the rural sector is faced with, as well as address the challenge of growth?
You see, you started by observing that this is an election budget. Now, I really do not know how you would define that. But so far as I am concerned and the way I look at the budget numbers, I think from the fiscal angle, it's a fiscally responsible budget. That means business. We have to remember that the current year, there was a lot of uncertainty around the GST revenues because it was the first year of implementation. And you are replacing a tax regime which has been, which was in prevalence for 70 years.
Yeah.
So therefore, given that GST revenues were lower, given that some of the non-tax revenues did not materialize, like for example, the auction of the telecom spectrum which got deferred.
Yeah.
I think current year, it was quite inevitable that 3.5% fiscal deficit, the fiscal deficit had to be 3.5% because obviously the government could not compromise on the expenditure front, especially with regard to infrastructure and other welfare and development programs. Now going forward for the next year, what is very critical to observe here is that the government has accepted the FRBM committee's report and has pegged the target of debt to GDP at 40%.
Yeah.
The entire FRBM report, the encasing committee report, all the recommendations are anchored on the 40% debt to GDP for the center.
Yeah.
So therefore, it is very heartening to note that the government has accepted that, and from that they have now sort of derived the fiscal deficit numbers for the current year. So 3.3% again for next year. You see, you have to remember that with so much expenditure compulsions, with so much expenditure requirements, which a country like, I'll just complete. With so many expenditure compulsions that the government has, it's always an easy option for any finance minister to go on increasing the allocations. But he has restrained himself and he has stuck to the target of 3.3%. Keeping the overall debt to GDP at 40%.
So you're saying that the number is credible because of the constraints that they put on themselves from an expenditure perspective?
Every government has to work within certain fiscal parameters, within the available resources. I mean, the requirement for a country like India is enormous. But within that constraint, take for example the infrastructure sector. If I remember correctly, I think the increase in infrastructure allocation has gone up from about 4.9 lakh crores to 5.97 lakh crores, which is a 25% jump in the overall allocation for infrastructure. So given the constraints in the revenue side, which any emerging economy has, I think the finance minister has done a wonderful job in allocating money wherever required. And one example I have given is the infrastructure sector, where there is a step up of 25%.
Very quickly, before I get Neelkant Mishra in, and then I'll come to you, Ajay Dua. The fact of the matter is that you're a member now of the 15th Finance Commission. How will you look at the budget, as well as the fact of the FRBM committee's recommendations being accepted now by the government? How will that bear on the 15th Finance Commission?
Well, I'm here in my personal capacity, and whatever views I'm giving are my personal views. The views of the 15th Finance Commission will be contained in the report, which will be submitted to the President of India, in October 2019.
Okay, that's the best I will get out of you. But let me go across to Neelkant Mishra. And Neelkant, thanks very much for joining us. When you came on in the morning, Neelkant, you said, I don't know why we make such a big fuss about the budget, because at the end of the day, it's an arithmetic exercise, it's an accounting exercise, and that's how it should be treated. But, be that as it may, Neelkant, we spent a large part of the day talking about the budget. From an arithmetic and an accounting perspective, has the budget delivered on the numbers, Neelkant?
I think it has. As we have seen in several of the past budgets as well, the revenue estimates are actually quite conservative. This is something that we've seen in particular with this government, that on almost all fronts, in fact, there has been a lot of debate on whether the GST targets are reasonable. Actually, they are. They assume, I think, very little growth, whereas on most contributors of indirect taxes, the nominal growths, say in plastics or metals, etc., automobiles, nominal growth is quite high. I think on the corporate taxes side, they've assumed just 10% growth, whereas I think there is a revival happening in corporate profitability, as shown in the, as very clearly seen in the Nifty EPS growth forecast, which we are talking about 15-20% growth. So there is, I think, these are very conservative numbers. And coming to the fiscal slippages, the FY18 slippage, if you see a 0.3% slippage, that's about ₹500 billion. Given that it was a GST year and the budget was made when it was not known whether GST was starting, and there's been, as I think we all know, 11 months of indirect taxes was at 12 months. That's ₹500 billion. So, once you adjust for that, actually there is no slippage. As regards expenditure growth, actually, I was expecting and I was hoping that expenditure would grow more than what has been budgeted. It is just 9% growth, and it is less than nominal GDP again. So expenditure to GDP will be the lowest since 1980. Now, this doesn't seem to be a very aggressive, far spending kind of budget. So it is an arithmetic exercise. They've tried to match the numbers, and that's the way we should read it.
Okay, Neelkan, let me ask you this specifically from the point of view of the markets. Okay, LTCG is here. It is now a reality. We saw that knee-jerk reaction and then we saw the market stabilize. But from here on, what is this going to mean, not just the tax, but also what we've seen in the budget from a domestic mutual fund perspective, from a fund flow perspective, from a valuation and an earnings perspective as well? How does it all come together from a markets perspective?
Yeah, so that's the only way to actually evaluate this budget from in my side of the world. So the first and most important thing is the government crowding out savings? Now, one reality is that financial savings as a percentage of GDP are going up. So we have seen that happen in the last 3 years. There's no reason why that should change this year. And earlier, the state and the central governments used to appropriate a very large part of that financial savings. 80-90% of incremental deposits would be borrowed by the government. That's no longer happening. In fact, there was a concern raised earlier on this on the show where state fiscal deficits, but actually state fiscal deficits have been in range. In fact, if you look at the fourth quarter borrowing targets given to state governments, it suggests that state fiscals will, aggregated will be 2.5%. I don't think that will change next year as well. So the governments are not crowding out private investment.
Any concern at all, Neelkan, on account of the Uday bonds when it comes to states? Because that's a concern that's been flagged in the
Uday
budget.
bonds. Yes. So the Uday bonds and the interest burden of that does add on to it. The Uday bonds issuance was I think FY16, 17, and they are now history. So in terms of the fiscal deficit or the incremental burden on the savings in the market, in the economy, I think that impact is behind us. Now, within savings, so then the question is, how do you allocate those savings? Where do you allocate those savings? There's been some, I think, disruption in the bond markets, and primarily because there is a structural problem there, which is that there's a lack of liquidity. And as banks, which are effectively 40% of all bond buying, have retracted from the market, there is some technical problem right now, which are the yields keep going up. But by and large, as financial savings are going up and you see the government crowding out less, I think that is good for cost of funds to come down, which means lower yields and also higher price to earnings. At the margin, the LTCG, what it does is, for the incremental rupee, the incremental dollar that is coming into Indian equities, yes, I mean, if I had 10,000 rupees to save, I would then think twice about putting money in whether, because earlier there was no tax on equities and long-term capital gains, and there was some on debt. My views can get a bit more balanced. But that's a very marginal impact. And because of the grandfathering, I think the impact on market prices should be muted.
Should be muted. I'll come back to Neelkan in just a second, but I want to address the growth issue with Chanda Kochur. And Chanda, we've talked about fiscal consolidation, but let's talk about growth and whether this budget has enough to be able to spur investments, to spur private capex. Corporate tax, at least for the large companies, there is no cut as far as the corporate tax rate is concerned. Is there enough in the budget to stimulate growth, Chanda?
Yeah, I think there is a lot of things there which can lead to stimulating growth and investment. If I look at it from two sides. One is, how does this increase consumption and therefore increase demand and investment? And on the other hand, you know, how do government spends push investment? So if you talk of consumption, you know, the whole rural spend of more than 14 lakh crores, how it's going to increase livelihoods with a very wide focus, I think, and including the rural housing and so on, and connectivity and roads and so on. I think that itself, increase in incomes leads to increase in consumption, leads to increase in capacity utilization, and therefore demand for investment. The other part is really the direct focus on infrastructure. So, you know, the spending on roads, the spending on railways, the spending on airports, some focus on defense, affordable housing. I think all this, therefore, in a way creates demand for steel, for cement, increases capacity utilization, and then that's how the investment will get triggered. And secondly, many of these actually give contracts, you know, to the medium scale industry, which then creates its own employment requirement for working capital and so on.
Let me just take that point across to you, Mr. Parekh. You know, there's been several comments that have come in that while there was an expectation that the finance minister would do that corporate tax cut as he had promised to, one can understand the compulsions and the constraints. But does this cost India its competitiveness? That is the question, Mr. Parekh. And there is disappointment. I mean, Mr. Godrej was on the program a short while ago saying he was disappointed with the fact that the finance minister hadn't done so.
Well, we all were expecting a marginal dip in the corporate taxation rate. He started the process by supporting, helping the smaller companies. And the smaller companies probably need more support because, you know, today the companies with small turnover, they find it very difficult to collect money when they sell goods to large companies. The fault is really with the big boys. The big boys don't pay on time. I know many large companies who buy goods, buy materials from medium companies, medium-sized companies. They take 6 and 9 months to pay them. So, you know, they are stretched. The banks don't give them adequate limit because of the receivables are extremely high. And the big boys, you know, there's competition, so they try and squeeze the suppliers. So it's a good beginning to at least recognize and support companies with 250 crore turnover.
Okay, it's a good idea to do
I'm sure
that.
the
Yes,
finance
Mr.
minister
Shaktika.
next year will extend it to other companies as well.
Okay, Mr. Das, you wanted to come in on that.
Yeah, you know, on this corporate tax thing, let us see it in the perspective. Now, the effective tax rate, as you know, in India has been lower, was 22%, then it was 23%, now it's about 23-24%. Now, most of it is really enjoyed by that 1% of the corporates, which is yet to be covered in this current 25% regime, which the finance minister has announced. Now, that's because it was the smaller companies which really do not invest from time to time to get the various benefits of the investment allowance or the depreciation allowance and other things. Okay. So they end up by paying the full 30%. Now, it was started 2 years ago. It was reduced to 25% for the manufacturing, from manufacturing companies. Then it became 25% for turnover up to 50 crores, and now it is 250 crores. So 99% of the companies are covered. And the rest 1%, many of them, their their effective tax rate as of today is actually lower than 25%.
Okay, Mr. Dua, on that issue, and then I want to bring up the issue of what we've seen happen on the customs duties, because again, as I pointed out, it's largely gone unnoticed. There's about 50 items where there's been a substantial jump as far as the customs duty is concerned. We've had this discussion, sir. You're in the Arvind Panagaria camp. You don't believe that this is the right approach to make in India. But that seems to be the stated objective of the government.
Yeah, let's get this right. The small and medium enterprises who have now received the benefit today of the turnover going up to 250 crores, a lot of them are intermediates and ancillaries of the large industries. You raise the issue of competitiveness for the larger ones. If they are able to source their goods
so
cheaper,
the chain becomes competitive.
Absolutely. And particularly in the context of the GST, now the benefit of one will definitely get passed on to the other. So I think given the constraints which the finance minister had on revenue, he couldn't possibly have played around with the tax
big boys, as
big boys,
said,
as well as for the middle class, the so-called complaint today that he hasn't done much for personal income tax for the middle class. He's kept it. He had a limited financial, fiscal space. The other issue which you've talked about, the customs duty. Yes, there has been tinkering with customs duty. The Made in India campaign for selected industries, the finance minister has hiked up the customs duty in order to give them protection. And the industries which have received this kind of protection are by and large the proven labor-intensive employment generating companies. To that extent, I think it was a highly desirable step, a step in the right direction. But had this been done for another set of companies, capital goods companies, or the ones which do not engage too much of labor, then there could have been a question that is there unnecessary...
So you support this move?
Absolutely. This is now what is first America? America first. Exactly the same thing, playing around with various tariff and non-tariff issues in order to give protection to your industry. So the finance minister has gone along in that manner. But at the same time, he's also hiked up a duty on a few items which may or may not as yet be, and one doesn't know what will be the impact on mobile handphones where he has hiked up the duty.
Yeah, from 15% to 20%,
That's
television
right.
sets, fruits, vegetables, juices, makeup,
but
hair
cashew nuts reduced by 2.5%. The point I'm just trying to make is that some of these for instance, the telephones had become a mass consumption item. If you hike up the customs duty, it could result in the local imports because they are importing a lot of these components from outside. It could impact them, not necessarily in a positive manner.
In a positive manner. William Foster, I know you have to go, so let me end by asking you, what would the Moody's headline be when you put out your report, if you haven't put it out already, on India?
Well, I don't know exactly what it'll be, but I think the most important thing to take away from this budget, it really did kind of meet our expectations in terms of the trying to balance fiscal prudence with growth objectives, and is consistent with the consolidation path, more or less, that we had expected, and to focus on the medium-term debt to GDP ratio over time, but relatively neutral and in line with our expectations.
All right, William, thanks very much for joining us. That's the Moody's view. Let me go back to Neelkant. And Neelkant, let me ask you now, what are the themes that you believe that the market is going to bet on in light of what we've seen the budget deliver today? There is that rural theme. So today we saw a bunch of those irrigation companies, the tractor stocks and so on and so forth moving up. I mean, valuations is a separate matter altogether. But in light of the fine print of the budget, what are the themes that you believe we will bet on? And what do you make of the disinvestment target that the government has set out as well? Non-tax revenues actually declining versus FY18. FY18, 1.4% and down to 1.3 for FY19.
Right. So I think you brought up several interesting points. So the first is on the non-tax revenue. Again, I think the government is being a bit conservative, in particular when it comes to getting dividends from the RBI. The RBI's dividend is effectively seigniorage income, which is that the currency in circulation, whatever is the currency in circulation, they hold assets against that, and the returns on that are passed along to the government as dividend. The average currency in circulation FY18 was significantly higher than the average currency in circulation FY17, and therefore the dividend should be higher this year, but they've assumed, I think, a flattish number. Coming to the rural spending growth, I'm actually surprised because there was nothing in the budget which suggests to me that there is a sharp spending increase in that will boost rural incomes. The only thing, and which I think is the only effective way to boost it in scale, is to raise farm prices. Now, as I've often said, half of India is a food consumer, half of India is a net food producer, and if you increase food prices, you are transferring more from the rich to the poor. Now, what happens
no, Neelkanth, I just want to
right now,
interrupt you on that point, because there's been so much talk on this business of whether the government has delivered on the rural income promise. And I had a very interesting conversation here with the likes of Yogendra Yadav, etc., who said that, you know what, the press in India is gullible. They're basically being fed the headlines and they're buying it hook, line and sinker. And similar stories coming in from the opposition as well, Neelkanth. So I really want to get to the heart of the matter here from your perspective on why you believe that there's nothing in it to improve income for farmers.
There's nothing in it to improve income for the farmers in this year. So, see, we have to also appreciate the fact that these are very complex structural problems. That if you have to improve, for example, farmer realizations without raising end consumer prices, because that has its own side effects. So what you're trying to do is get the farmer a bigger share of the pie, or you have to improve farm exports. So there were some very interesting and exciting things and very encouraging things that were announced in the budget, in the sense that there was, about cluster development, about promoting, produce which is of global quality, and then allowing for farm export. That's the only way to solve this problem structurally. And I think, but the issue is from a fiscal spending perspective, and what happens in the next 6 months, next 12 months, which is what unfortunately the markets will look at. So there wasn't any meaningful increase in spending growth. The MSP increase, the minimum support price increase, is something that can potentially do that. And I think there has been that is another concern of the bond markets, that can that really fuel a rise in inflation. And I again think that this is something which is not easy to do. Minimum support prices are only defined on about 35% of India's agricultural output. And even on the crops where the government does do procurement, like rice and wheat, only about a third of the procurement or the produce of the output is procured by the government. So the net impact, not as much. And lastly, if you see the last report of the CACP, the Committee on Agricultural Costs and Prices, where the costs of production of these crops are specified, on many of these crops already the margins are above 50%. So on some like rice, paddy, there could be some increase next year in the Kharif season, but even there I think the impact will be minimal. This is a tough problem. We shouldn't expect the government to be throwing money at it and solving it, because that will only cause inflation.
I agree with you.
Again will distort incentives.
I agree with you there. I'll do a quick final word on this.
I think the focus on shifting to agriculture and rural sector absolutely called for, 40 paragraphs in the budget speech as well. But the allocation of money, that hasn't been commensurate with all the promises which has been made.
Okay.
It's only about 10% more than last year. Fiscal issues, etc., we all understand.
Yeah.
But the fact of the matter is the schemes which are actually the minimum support price scheme, for instance, those need to be enlarged considerably. Today they are covering only 23 crops. And 94% of the agriculture produce is not covered. Basically the perishables or the entire horticulture sector. And the rest of the schemes, the government is relying heavily on institutional finance.
Right.
NABARD, last year credit directly and through cooperatives, 10 lakh crores, this year 11 lakh crores.
Right.
So certainly the focus needed to be also backed up by far greater outlays than they've been able to make.
The final word to you, sir, before we head into a break. What would your headline be,
on the farmers' income, the point was earlier made. Now the finance minister has said that it will be cost plus 50%. Yeah. Now one important announcement I think he has also made in the budget speech is that, look at the situation with regard to MSP today. Large number of farmers who actually cultivate the land, it could be a tenant, it could be a, it could be in remote areas, or it could be a sharecropper. They really do not get the benefit of the MSP. But I think the finance minister has very rightly announced in the budget speech that the Niti Aayog will work out a mechanism to see that the benefit of MSP reaches a wider and a larger section of farmers.
And the Vice Chairman of the Niti Aayog told me that they should hopefully be ready with that discussion in the next 3 months and hopefully roll out the new scheme over the next 6 months or so. But we will have to leave it there. Shaktikanta Das and Ajay Dua. Neelkant Mishra, appreciate you joining us here on CNBC TV18. Thanks so much for your time, for staying up late this evening to decode the budget for our viewers here. We'll take a quick break, but when we return, we continue our conversations. The Prime Minister's Economic Advisory Council member, Rathin Roy, will join us. We'll also continue our chat with Deepak Parikh and Chanda Kochar. We've got a whole host and a wide variety of reactions to Budget 2018 and what it means for the Indian economy, what it means for corporate taxes, what it means for you and me. Joining us now from the Prime Minister's Economic Advisory Council is Rathin Roy. Mr. Roy, appreciate you joining us here on CNBC TV18. Let me start by asking you about what the PMEAC will now make of the fiscal consolidation plan that the government has put forward. Some would argue, well, you know, you've slipped and it's not that much of a consolidation at all.
It's better than 3.5. So to that extent, it is fiscal consolidation. Obviously, what has happened is that the calibration of the fiscal roadmap has changed somewhat in terms of its time duration. Because last year we would have been at, if we had kept to 3, then we would have been at 3 last year. There would have been a pause this year. But we decided to go to 3.2. Now, there's no denying it. We haven't achieved 3.2 this year, so we are at 3.5, and therefore the government has perhaps decided to have a sort of slower glide path to fiscal consolidation than originally envisaged.
Okay, that's as far as the fiscal plan is concerned, but the budget assumes growth in tax revenues of about 17% and a growth in personal income tax of about 20-odd%. You know, so would you be okay with those numbers? Do you believe that that's doable, it's achievable?
No, I think it's very conservative. I prefer to look at these things in terms of percentage of GDP. And if you look at tax revenues as percentage of GDP, the projected rise is by about 0.34% of GDP across time. And it's a fair mixture of more ambitious effort on GST, because obviously next year one expects GST collections A to be for 12 months and B to be somewhat higher as things stabilize than this year. And for corporate income taxes and personal income tax rises to take an equivalent share of the burden. So I think it's a reasonably modest projection of increases in the tax GDP ratio. I think it's okay.
Okay, let me then ask you a quick question, Rathin Roy, as far as the cost of capital is concerned, because let's take a look at the bond market movement. The 10-year yield has gone to 7.8%. So are you now getting concerned about the cost of capital and whether that's been pushed up?
You get what you pay for. If the fiscal deficit increases, then obviously that is going to be reflected in higher cost of capital, ceteris paribus. There is only a limited amount of domestic saving which has to be shared between government, the public sector and the private sector. So to the extent that government share is more than it bargained for, you are going to see an increase in the demand for capital by one client in the bond markets, and then obviously prices will rise. So that's a natural consequence. Now, whether that will affect growth or not depends on your view of the economy. If you think there's a problem with private sector market, capital not being invested and savings not being utilized efficiently, then this is a good thing, notwithstanding the price of capital. If you, however, think that the price of capital is a major factor that is inhibiting private investment, then this is the price you pay for a higher fiscal deficit. It's simple arithmetic. So the bond markets, I do not think, having said that, I think the bond markets may have overreacted a little bit, because the increase in the fiscal deficit this year is, and only a little bit, they were right to overreact because we are now on a higher fiscal deficit glide path than we were before, it's right to react. But I thought a lot of that had already been factored in by the bond markets in terms of the 110 basis point rise that we saw over the last 4 months. So I suspect there will be a tempering of this rise in bond yields in the next 2 or 3 months.
So you believe that there might be an overreaction there from the bond market? And well, you know, Neelkant Mishra, just a short while ago, Rathin Roy was also alluding to the fact that there seems to be some technical problem there in the bond market. But always a pleasure. Many thanks for joining us with a quick reaction here on what you make of Budget 2018. PMEAC member Rathin Roy. Quick break. When we come back, wrap-up comments from Deepak Parikh and Chanda Kochar. Welcome back. You're watching our continuing coverage here as we decode Budget 2018. Two of India's top bankers, Deepak Parekh and Chanda Kochhar, are still with us for their wrap-up comments. Mr. Parekh, long-term capital gains, the markets have weathered that. But in terms of clarifications, if any, what is it that you would like to hear from the government specifically on that issue? And do you believe that that will sour sentiment beyond just the immediate short term?
No, that... Well, that has been clarified, but there is another issue that I think it was in the last year that if STT has not been paid, then there is no capital gains tax exemption. Now, you know, subsequently the government passed through a notification that even in select cases like offer for sale, preferential allotment, QIP, ADR issues or ESOPs, the same rule will continue. So we are looking for that clarity from the budget, from the finance minister. He has put a clause in this section 1038 that any other things can be notified afterwards. So I think we all are hoping, because see, for instance, we are in the process of raising large sums of equity through offer for sale and QIP. Now this will be in February and March. And we've already got queries from our international investors that how will the tax impact us? Because on 31st December, they're not shareholders. And will they have to pay 10% tax? So, you know, there is a little bit of ambiguity in that, but we hope that the Revenue Department will clarify this as they did last year.
And I would imagine we will get clarifications from the government on those specific issues as well. Chanda, let me end then with you. What do you believe will be the most significant impact of Budget 2018? There's been lots of themes that's been addressed, but perhaps the rural and the agri theme has been the one that the government has tried its best to focus on. Given everything that we've seen, do you believe in the short term? Because a lot of these are structural issues that need to be addressed, and these are complex problems. But in the short term, is there enough to alleviate the pain for the agri sector?
No, I think, you know, the biggest impact of this budget is that it's actually very holistic in its approach of, one, looking at various segments in the economy, and the second is looking at both the social and the investment needs. So what I mean by this is that, you know, it talks of the rural economy, it talks of senior citizens, it talks of you know, the younger economy in terms of technology oriented solutions and so on. But not just that, within rural, you know, it's not just about MSPs. It's about saying fisheries are important, agricultural produces, processing is important. It's about saying roads connectivities will be done, housing will be done, health, such a big focus on health, you know, outcome oriented focus on education. So I think it's very holistic in its approach. And while some of the impact may take a little long term to come by, but some of these, you know, will be actually quite immediate. And I think some of these actually create the multiplier impact, which is a positive sign. So I definitely think that this will lead to increase in incomes and livelihoods, and therefore increase in demand and growth.
And that is what the government will be hoping for as well, the multiplier impact. Chanda Kochhar, Deepak Parekh, appreciate you joining us. Well, that is it. The speculation is over, the suspense is over, it's done and dusted. Budget 2018 is over. We brought you the headlines, we brought you the key policy makers, we brought you the budget makers, corporate reactions, market reactions. Today the markets braced themselves and recovered towards the close. What will the trading setup look like tomorrow? Join us bright and early as we take stock of the markets. And of course, remember, we have Finance Minister Arun Jaitley live and exclusive, 9:30 in the morning. Here's a glimpse of his budget speech, and we'll see you again with more.